Hey there, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. It is Friday, November 7th, and you are tuned into the Friday Chart Fix. Thank you very much for joining us. I do appreciate it. So today we're going to cover a very mixed market. I would not call it a bear market because the cup is still half full. We'll look at two breadth indicators to confirm that. We'll look at the sector performance, and we see that one sector stands out over three different time frames, outperforming, and that would be healthcare. And it shows internal improvement as well when we look at breadth, and the price chart shows healthcare extending on its breakout. And then we wonder where the weakness is coming from in the market. Well, one of the culprits is consumer discretionary, and that's kind of a negative sign for the broader market because it is the most economically sensitive sector. Let's hit those charts. So this first chart here shows SPY in the top window, and it's in an uptrend. You can see it's above the rising 200-day, and it hit a 52-week high there in October. So if we look at SPY, it's definitely in a long-term uptrend. We could have pullbacks, we could have corrections along the way, but for now, the trend is up until proven otherwise. Now, if we look at the indicators, we can see that this is not a bull market that is lifting all boats. If you go back to 2024, this was a bull market that lifted most boats. You can see here, this is a percentage of stocks above the 200-day moving average, and it had this surge into December 2023, and for most of 2024, it held above 60%. It never went below 60% until December, mid-December 2024. So this was a strong bull market where most stocks were participating, and it was a good stock pickers market because your chances of picking a winner are higher when you have this high of a percentage of stocks above the 200-day. And then, of course, we had the weakness into January, February, and then we broke below 50% in March. And that's kind of the first level to watch for signs of trouble because clearly the cup is half full when more than 50% are above their 200-day, and it's half empty when more than 50% are below their 200-day. And so if we get that cross below 50% for a percent above 200-day, that means more than 50% are below. So if we look at the current situation, we can see we pretty much got bullish with that move in late June when we got to 65 or so percent. And we hovered around 60% above and below for several months. And we've moved down to 53% now. So yeah, that's the lowest reading since June, late June. And that shows that there's a split market out there because if 53% of stocks are above the 200-day, 47% are below in long-term downtrends, and that's a sizable portion of the market. Is it a bear market number? Not really, because technically 53, more than half, are above the 200-day, but this is getting close to getting below 50%, which would be a negative. Now, the next indicator is high-low percent. That's the percentage of stocks making new highs, less the percentage of stocks making new lows. And you can see this indicator was above 10%, even above 20% on a regular basis throughout this bull market in 2024. And then we look at the bull market that we've had now since, say, this mid-May break above the 200-day in SPY in the top window. You can see we've only had one day above plus 10%. We did hit 10% twice, but we only got above it once. So this means we're kind of limited as far as the number of leaders are concerned because a stock that's hitting a 52-week high is in a strong and leading uptrend. Now, a stock hitting a 52-week low, of course, is in a strong downtrend. And this indicator, even though it's not impressive, it's not negative until the last 6 days. You can see we started to get negative readings. Now, we got negative readings in December and in January, and it wasn't until in March and especially early April when that expanded and that became real trouble. But of course, the first indicator to watch is that breakdown. If we get a breakdown in percent above 200-day, that would be another red flag out there for the market as far as internals and breadth are concerned. So when the market is weak, I try to find out what is holding up well or outperforming. And stocks were hit with some selling pressure over the past week. You can see here is SPY. It's down 1.4% over the past week. And this is from the close last week, Thursday, to the close yesterday, Thursday, November 6th. So SPY down 1.4%, technology leading the way lower, down 3.74%, comm services down 1.7%. These two were leading in September and into the latter part of October. Now they're lagging or leading on the way down. But look what's holding up. Healthcare up 1.14% over the past week. We're also seeing energy, consumer discretionary, which is basically dominated by Amazon and Tesla, the XLY ETF that is, and financials up 0.34%. But one time frame is usually not enough on which to judge something. I mean, healthcare is holding up for 1 week. Okay, big deal. How's it doing over different time frames? Well, if I change this to the past month, and I'm doing the sort is on a performance sort here, but you can see here, healthcare is up 1.26%, and it's the leading sector. I've got technology up 0.5%. So over the past month, technology is still one of the leading sectors. But look at SPY, it's actually down. And then the other 9 sectors are down, with materials getting hit really hard over the past month, and communication services also taking a hit. And then I wanted to look at one more time frame, the 3-month time frame. And so if you right click on this slider, I go to 3 months, and we can see, look at the leading sector. Healthcare up almost 12%, technology up almost 10%. These are the 2 leading sectors over the last 3 months. So even though technology is lagging over the past week, it's still on the leaderboard on a 1-month and 3-month time frame. So it's not that bad. But one thing that stood out on this exercise is only one sector was up over all 3 time frames, and that was healthcare. Healthcare is up over the past week, over the past month, and over the past 3 months. So we're seeing relative strength in healthcare. And then if you look over the past 3 months, SPY is up around 6%. And again, only 2 sectors outperforming. That's crazy. The other 9 sectors are underperforming, and 2 are even down over the last 3 months. And financials are probably the relative weakest, if you will, of those that are up only 0.9%, and industrials dragging their feet up only 1.1%. So I'm interested in the price of the sector SPDRs as far as performance is, but I'm also interested in what is happening within those sector SPDRs, the breadth indicators. I want to see sector SPDRs that are in uptrends and also showing improvement or strong internal strength. And I use that, or I measure that by using the percentage of stocks above the 200-day EMA. Now, this is a chart list that I created, and it has the percent above 200-day EMA for some major indexes and the 11 sector SPDRs. You can see utilities at the top because I'm ranking by the value here. So 90% of utility stocks are above their 200-day EMAs. It is by far the leader. And if you see over in the upper left, I've got 3 months for the time frame. And then as far as the columns are concerned, you can see that I've got the last, so I've got last and I've got change. This is the absolute or the numeric change, if you will, not the percentage change. I want to know their 3-month percentage change in percent above 200-day EMA. And then this little plus minus bar kind of gives you a visual representation. But if you look at this here, we can see that energy has one of the biggest improvements in breadth, up 27.27. So it's above 60%. It's the second leading sector in the S&P 500 as far as breadth. Finance at 60%, but deteriorated, down 9.44. Industrials at 58%, down -8. And then we have healthcare at 56.67%, but a big improvement over the last 3 months, up 20.60. That is a strong improvement in breadth, and that's something I want to see. So we're seeing money move into stocks related to healthcare and energy over the last 3 months based on these improving breadth indicators. Now, what's getting hit? Well, if you look at technology, you can see it's still at 53% roughly. So roughly 47% of stocks in the technology sector are below their 200-day EMAs. they're in long-term downtrend. That's a negative. And you can see this indicator is down 13 over the last 3 months. So some deterioration within technology. And then we look at consumer discretionary. It's at 45%, which means 55% of consumer discretionary stocks are below their 200-day EMAs. The majority, and it took a big hit, minus 25. So we're seeing technology and consumer discretionary take hits based on the percentage of stocks above the 200-day EMA. And that's a negative, I think, for the market because technology is still the biggest sector out there and consumer discretionary is still the most economically sensitive sector. So we are monitoring the situation with the breadth indicators, and we're also looking at the sectors, industry groups, and stocks that are showing the most strength over the last week, month, and 3 months, because those are the emerging leaders or laggards. And we update our commentary on Tuesday, Wednesdays, and Thursdays, and each commentary report includes a video. Now, if you want to know more about the services at TrendInvestorPro, you can go to the Premium Services link, and at the bottom there's a Getting Started link. And if you click on that link, that will take you to a page that describes the offering and also has a video going over our offerings. We also have the current report and video page where you can find all of our recent analysis. And on Thursday, we covered gold and silver and bonds because all three of those are setting up with oversold conditions or pullbacks within uptrends. And also compared Bitcoin to QQQ because Bitcoin is lagging the market over the last 3 months. And that means the speculation is drying up in the market, and that could ultimately weigh on QQQ. And we look at the correlation between Bitcoin and QQQ, as well as the market regime where we identify bull and bear market shifts. Right now, we're still in a bull market, but we're watching the yield spreads because if they break out, that would show some stress in the credit markets. And you can find those charts on the market regime page. And we also cover stocks as well as ETFs on a regular basis, looking for the leaders and looking for pullbacks within leading uptrends. So take a trial to trendinvestorpro.com to learn more. So speaking of the leaders, how do we identify the leaders? Well, I showed those performance rankings over the 3 time frames. I showed the percent above the 200-day EMA, and then you look at a basic price chart. And if we look at XLV, and we've highlighted this chart several times over the last few months, we have a double bottom here with 2 lows in May and August. And then there's that big surge, and we got the breakout. And then we kind of consolidated and dipped around the 200-day. And then we got the second breakout surge. That's like the follow through. And that was clearly a bullish surge there. So we have 2 breakouts working in XLY. And you can see it moving higher this week when the market was under pressure. So I think there's a valid breakout working here. Who knows what happens between 140 and 146. You know, you could get some choppy action. But you can see that 200-day starting to turn up. So I think there is a long-term uptrend working in XLV. And I will be looking for pullbacks along the way, as well as focusing on stocks within this sector for trades and for the momentum leaders. If we look at the indicator window, you can see the price relative breaking out there in late September. So that's the first higher high in a while. And then you broke above the 200-day this week. So we're starting to see healthcare outperform the broader market, which is also a positive. So if we want to know where the weakness is, we also look at the price charts and the breadth indicators. And I told you that the consumer discretionary looks weak. Now, I'm not talking about XLY so much because, as I said, XLY is dominated by Amazon and Tesla. You've got to look at the equal weight consumer discretionary SPDR to get an idea of how the sector as a whole is doing. And as I said, consumer discretionary is the most economically sensitive sector within the S&P 500. It includes retailers. It includes restaurants. It includes housing. Those are very economically sensitive groups. And if we look at this chart here, we can see that we have a peak there in September, and SPY and QQQ are moving to new highs in October, but RSPD, the equal weight consumer discretionary, is moving lower with a lower high, and this week it broke below that October low. So we have a clear downtrend here because we've got a lower high and a lower low, and we're on the verge of breaking the 200-day. And if you look back in March, You can see in early March, we had a lower low, a break. We had a lower high as well. And then we broke below the 200-day, and then all heck broke loose in April there. In the indicator window, we got percent above 200-day EMA for the consumer discretionary sector. And you can see it's doing fine. August, September, October, into December and January. But the February, you get that first cross below 50%. And then in March, a definitive cross below 50%. And that was another warning sign. And if we look at it now, we're doing fine, July into October. But now we've got a cross below 50%. So that means more than 50% of stocks in this key sector are below their 200-day moving average. And that is a negative because they're in long-term downtrends. And so that's a negative, I think, definitely for small caps and mid caps, some of these economically sensitive groups here. Large caps, which are still dominated by the Mag 7 and techs, less so. But we did get a bearish signal in SPY and QQQ this week. We have a momentum indicator that we foreshadowed last week, and it did trigger this week to signal a correction. So take a trial to TrendInvestorPro.com if you'd like to see that setup. So that's it for the Friday chart fix. In a nutshell, we're still in a bull market because the cup is half full. Now, as far as being half full, it's almost literally exactly half full because 53% of stocks are above their 200-day, 47% below. But we're watching our breadth models, and they have yet to turn bearish. We're watching yield spreads. They have yet to widen significantly to signal stress in the credit markets. But we're watching those, and I'll update the market regime page next week for those indicators. But we're seeing weakness in consumer discretionary. That's a negative for small and mid caps and the more economically sensitive side of the market. But on the plus side, we're seeing strength in healthcare, internally and externally with that double bottom breakout holding and extending. So thanks very much for tuning in and have a great day.